The first thing I would say about success in general is don't worry too much about what the rest of the world thinks about you. And I'll tell you the short answer, it's not much. It's amazing how little people think about other people. Most of the time, we are the center of our own universe here. So I used to say, at any moment, 10% of the viewers thought I was a genius, 10% thought I was a moron, and the other 80% were indifferent or undecided.
Today's guest is a legendary voice in financial journalism, Bob Pisani. For 35 years, Bob reported live from the floor of the New York Stock Exchange as CNBC's senior markets correspondent. In that time, he became one of the most trusted figures in business news, guiding millions of viewers through the market booms, busts, and everything in between. Bob's career spanned some of the most pivotal financial moments of our time: the Asian currency crisis, the dot-com boom and bust, the great financial crisis, I remember that, the rise of ETFs, and the unprecedented volatility of the COVID-19 era. His ability to cut through noise and explain what really drives Wall Street earned him accolades, including a Lifetime Achievement Award from the Security Traders Association, recognition from the Market Technicians Association, and introduction into the Securities Traders Hall of Fame. His 2022 book, Shut Up and Keep Talking: Lessons on Life and Investing from the Floor of the New York Stock Exchange, offers not only timeless investment wisdom, but also vivid behind-the-scenes stories. From interviews with CEOs and politicians to encounters with celebrities like Aretha Franklin and Robert Downey Jr., and even a memorable conversation with Fidel Castro in Cuba. I got to ask you about that. Bob's speaking and writing continue his mission, demystifying markets, illuminating investor psychology, and helping audiences understand the forces shaping global finance. Before we dive in, don't forget to like, share, and subscribe to the Matthews Mentality Podcast. Bob, welcome to the show.
Thank you, Kyle. It's delightful to be here in Nashville. I do many podcasts over the years, but yours was particularly interesting to me because it focuses, it seems to me, on the success mentality and what makes people successful in their careers. So most of the time I talk about the stock market, the bond market, the economy and things like that. I don't often get to talk about leadership and success, and that intrigued me about your podcast. So that's frankly why I'm here. I had to actually think a little bit about it.
I appreciate that. That's awesome to hear. That's ultimately why I agreed to it. I've told the story before, but our marketing team came to me three and a half years ago. Hey, we want you to do a podcast, and I'm in, as you know, in real estate and a real estate podcast. And I was like, I don't really want to do a real estate podcast. There's enough real estate podcasts out, and I don't know if it's that interesting. And I thought about it. And then I circled back to him. I said, hey, you know what? I'll do a podcast, but here's what I want to do. Certainly there will be people in real estate who come on, but I'd love to really explore and dive into the mentalities, the motivations, and ultimately what drives high achievers, whether they're in the television business, the finance business, real estate, sports, entertainment, anything. And it's been fascinating. Allison, what episode is this? Like 80th? 81? Yeah. So like 80 conversations across the whole spectrum of professions. And it's been really cool. And it's been amazing what I've learned. And there are commonalities, there are traits with high achievers and driven people, but then everybody's story is unique to them. And so what I like to do and what I'll do with you is I'd love to hear, kind of your story, your career arc, and then ask you what motivated you. But before we dive in, I actually do want to hear your opinion on the financial markets. You actually have a background in real estate, yeah?
I grew up in the real estate business in Philadelphia. My father was a well-known land developer, built apartments, and was really Horatio Alger, a poor Italian kid from the Bronx who we moved to Bucks County, Pennsylvania when I was a kid. And he was originally worked for United Airlines and got into the real estate development business in the early 60s, built pools for the Sylvan Pool Company. A lot of construction guys get into the pool business and then move on to other things. And I grew up in that business. And my father was a real Horatio Alger type. We became friends with the head of the Wharton Real Estate Center in the early 1980s and convinced the fellow who ran the place and the dean of Wharton School to bring in my father to teach a course on fundamentals of real estate development at the Wharton School. And the course centered on construction. My father became an adjunct / lecturer and brought me in to help teach the course. And we ultimately wrote a book called Anatomy of Land Development and How to Be a Successful Developer that Wiley published in '89. And by sheer dumb luck, CNBC went on the air in April '89, the month the book came out. And there's a little bit about serendipity for you.
Well, I was going to ask, how did you go from real estate to TV? And this is how.
That's what happened. And ultimately, one of my best friends got one of the first jobs at CNBC as a producer. She called me up and said, NBC has this new cable company called CNBC, which obviously means cable NBC, but they decided it meant the Consumer News and Business Channel. They wanted to go on, this is April '89, they wanted to start business in the cable. The only companies that were making any money in cable was CNN and MTV, which is famous for rock and roll videos. They decided, NBC, that they wanted to have a competing news channel with CNN, but they didn't want to just do general news. So they decided on this general idea, Consumer News and Business Channel, which vaguely meant anything about investing, anything about the markets in general. And ultimately, they invited me on as a guest on real estate and hired me as the real estate correspondent. So there's a little bit about serendipity for you. If my friend had not been there, I probably wouldn't have gotten the job. I grew up wanting to be a journalist my whole life, but not a financial journalist. I wanted to talk about science. I was very interested in the space program. I studied physics and mathematics. But you know, you play the cards that are dealt with you. And when I got that job, it was the perfect melding of all of my talents. I don't know what you, Kyle, consider your core competency. What are you really good at? I know people say, oh, he runs a real estate. But I know you don't think your core competency is, I run a real estate company. You have certain leadership skills and talents that you would look at and say, this is what I'm good at. What I'm good at, I'm outstanding writer. I know how to take complicated stuff, whether it's general relativity theory or real estate or the stock market, and explain it in simple terms. I know how to do research. I know how to interview people. I'm relentlessly curious about the world. I suspect you are too, and probably list that as an attribute of yourself. And I have particularly strong speaking skills. And this is a very important thing of what separates broadcast journalists from print journalists. I can talk on my feet. I can talk in front of a crowd, and I've always been good at it. We were the class clowns. A lot of TV reporters were class clowns when they were growing up. I suspect you have these skills. So these are core. This is what I'm really, really good at. And when I saw this job at CNBC, they offered me real estate correspondent. I said, well, I didn't really want to grow up to be the real estate correspondent. My father always used to joke with me, you didn't like the real estate business, kid, but I helped you get into the real estate correspondent business. I said, I can't say no to this. So there's a good example. Sheer serendipity. My friend got the job. I got in. I wasn't exactly what I wanted, but it was the perfect fit of my skills. And I always like to tell people, look, you're not a leaf blowing around in the wind. You can determine your future, but don't be a fool and dismiss the role of serendipity in anybody's life.
Well, public speaking is such a fear for so many people, like certainly for myself, and you do it enough, you get over it, and I've had to do some of it. I could only imagine television even more, right? Because it's public speaking, but it's broadcast to millions of people. You touched on this earlier. Were you just always comfortable speaking, talking, and ostensibly behind a mic, or was that something you had to develop?
You can learn to do it, but there are people who are innately good at it, and I was the class clown in school. In fifth grade, me and my best friend Charles Sachs sit in the back of the room doing fart jokes, and the teacher would say, Bobby Pisani, why don't you come up here and tell us all what's so funny you and your buddy Charles are laughing about? And of course, she wants to, humiliate me. And I'd stand up in front of the room and I'd go all George Carlin on them. I'd kill them. I mean, I just entertained the class. I was good at that. And I wasn't afraid of it. I knew how to look people in the eye. And there is just a certain skill about taking what you want to say and being able to say it fairly quickly. And like I said, you can learn it, but innate skill is always superior to a learned skill, I think.
So you went from, real estate correspondent to just general financial correspondent. What are some things you learned having ostensibly covered financial investing for so long, that seems to be like a common denominator in successful investors?
Well, if you ask me about leadership skills, things that matter. There's in the back of my book, Shut Up and Keep Talking, there's an appendix called 58 Maxims on Life, Television, and the Stock Market. And there's sort of like leadership and maxims. Maxim number 1 is thou shalt make air. This is the most important thing. If you don't make air, it doesn't matter. Woody Allen once said, 80% of success is just showing up.
Mhm.
It's amazing how many people never show up. It's incredible. They don't put enough effort in, or they physically don't show up for the hit. That is just a killer. So thou shalt make air was sort of like the number one thing for me. In terms of other things, don't be a jerk. People ask me, well, how did you last 35 years at CNBC in the television business? Well, other than thou shalt make air, don't be a jerk. Have some respect for other people. Treat people, including management, in a respectful manner, and you'll get a positive response from most people. I always say, talk, make sense, employed. Don't talk, don't make sense, unemployed. Work hard. Be an important part of the team. Do your job. Don't whine. If you have an issue with management, go explain it to them. But the important thing is, I always say my contracts got renewed every 3 years. What I wanted them to believe was, at the end of it, the president says, Pisani's contract's up for renewal. Hey, he's one of ours. We want him. I mean, of course. And when I walked into the room to see the president, once or twice a year, we'd have a drink. He'd walk in the room. Pisani, what's up? I never want him to think, oh, what is this asshole on? You want him to be happy to see you. And so you want to have a relationship. And it's amazing how many people kept saying to me, management's not your friend, Bob. I know they're not my friend. I know that. But that doesn't mean they're hostile to me. And that doesn't mean I can't have a respectful relationship. And people laugh at me for this, but one of the reasons I lasted was that relationship that held very well. So
let me ask you this, like style and presentation are so critical in both media and markets, right? Clearly. But how does the way, in your opinion, how does the way you come across to clients, colleagues, audiences, how does that, what effect does that ultimately have on your ability to achieve success?
Well, if you mean physical presentation, it matters a lot.
Let's start there. Let's start there because, again, we are seeing I don't know if this is the right word, a casualization of America where we have young men and women coming out of college and they come here and interview and they show up in, like a T-shirt and sneakers.
Yeah, that's kind of shocking. Do I look casual to you? My wife used to sell men's clothing, so I always say, I'm just Ken, she's Barbie. So, it matters a lot. Presentation matters a lot. I always like to say content always trumps presentation, but make sure your tie is straight. That means show up looking presentable to people. It really does matter. Television is a very, very hot medium. So you could sit there and talk all day long, but if your tie is crooked, it will be remembered. If your hair looks completely out of place, there are famous stories in the television industry of people giving award-winning presentations and their hair looks wrong and they get
that's all
comments
people can
about that.
focus on, yeah.
My mother has called me and said, Robert, that was very nice what you had to say today, but your tie was crooked. Please make sure that's better. Or your pocket square, I'm famous for my pocket square, didn't quite match there. So pay attention to that kind of stuff.
And have a good critic who will be honest with you, right?
Your mother.
Strong mother, yeah.
People ask me about how you talk and style, and they ask me if I ever get nervous when I'm on the air. I never get nervous, but I'm always in a state of mild agitation. And this is that sort of fight or flight thing that kind of amps you up in terms of the adrenaline to keep you sharp and aware. So there's a reason that these kinds of things, this adrenaline exists to survive. So when you're out in the wild, when we're cavemen out in the wild and you saw a tiger, your adrenaline went up.
Sure.
Hopefully when the tiger went away, your adrenaline went back down. One of the things that happens when you're in this game for a long time is you're in a constant state of mild agitation. So neurologically, you pay a little bit of a price for this. When you're constantly mildly agitated, my wife will tell you, I used to see her Friday nights was a date night. She'd always say, all right, calm down. Calm down a little bit because I'm just like so, and people who are not used to being around that will see
work
it.
Bob, come down.
Calm down. Everything's going to be good. So you pay a little bit of a price for that.
So certainly how you physically present. What about communication style, or are there certain ways to get people to like you more?
Yes. People ask me about my interviewing styles all the time, and one of the mild jokes that are in there in the book on the Maxims is never interview or avoid interviewing people wearing sunglasses. And the reason I said that is when you're talking to somebody, nonverbal communication is extremely important, and eye contact conveys a lot. So when you're looking at somebody, intensity of the gaze kind of gives you a sense that they're paying close attention.
Mm-hmm.
When you're watching them talk to you, you want to watch them if they move their eyes. If they're averting their eyes or moving away, this is why I made the joke about not wearing sunglasses. It's hard to get a sense because as human beings, we're very attuned to body language and things like eye contact. When talking to people, an interview should sound like a conversation, not an interrogation. And this is a mistake a lot of amateurs make. Now, if you're in a high-profile, big news interview and you're talking to the vice president about something, it's going to be a little tense because you're trying to get important information out. But generally, you want to talk to somebody like a conversation. And I always call this the non-interview interview. One of my fortes was going out with people socially and chatting with them. And it's actually an interview, but it doesn't look like an interview. I'm actually having a purpose here in that I'm talking to you about what do you think of the markets, and I'm trying to use your opinion on the market so it would inform my own reporting the next day. So I call this the non-interview interview, which is having a conversation with people where they're not so tense, where you're sitting there with a pen in your paper thinking that you're going to write things down necessarily.
When you're interviewing people, and again, and I agree, like interview is the word people use, and I think we all understand that moment, but like it's really a conversation. So when conversing with people,
Right.
just so happens to be an interview, how do you draw out that useful information and understand people's business and in a way get them to be comfortable with you without interrogating and without being intrusive?
You want to, again, have a conversation with them. So people ask me all the time, like, well, what happens if they don't say what you want them to say, or they're avoiding, or they don't give you an efficient answer? One of the things that I've learned to do is simply say nothing. So suppose I ask you a question and I'm trying to elicit an answer, and you don't really give me an answer that's sufficient or interesting. One of the things that I do is say nothing, just stare at you for a few seconds. And what happens with human beings is they hate a vacuum. So if you and I suddenly stop talking here, one of us is always talking. If both of us suddenly start talking, stop talking and stare at each other,
yeah,
you're going to try to fill in that space very quickly. So if I'm asking you something and you give me a 10-second answer and it's not really sufficient, I can do a couple things. One of the things I do is just say nothing, just stare. And I'm waiting for you to start saying something else because you're going to want to explain yourself because I'm not saying anything. I'm just staring at you and you want to fill that space. If he's really good and determined and he's had his PR people saying, don't say anything, you can stare a little bit more and you can say, explain that more to me. Be very brief. There are points at which it gets obtrusive and annoying to the interviewee, and eventually you have to move on. But that's one way to simply try to elicit more information out of people. Another thing that's kind of difficult that some people, amateur interviewers have a hard time is they want to know the truth about what's really going on. And I don't want to get into epistemology or knowledge, but most issues are shades of gray. There's very little real black and white in life. And I found it, as time went on, to be very careful about demanding to know the truth about everything, because sometimes it's not as black and white as you might think it is, even on simple issues. So I give a lot of tolerance for people. The most important thing in this game is, do I advance the knowledge? Tell me something I don't know. It's basically what journalism is all about. And let's see if I can find out something a little more than I knew before.
Were you great at drawing things out of people and ultimately getting them to tell you something you didn't know? Was there a moment in your career where you did get something out of someone that was a scoop, but maybe got that person in trouble, or it led to something where you're like, man, I feel bad. I feel guilty. Like I got him to give me some information that ultimately he shouldn't have, and it put that person in a...
I never got anybody fired. I had interviews or discussions where I had on background interviews with people that were where their firm didn't want them talking to anybody. So you get situations where you have news breaking and you have something going on with some major firm, Wall Street firm, pick a firm, it doesn't matter.
Bear Stearns.
And you go, and you long gone.
Yeah.
you want to know something about what's going on, and you call some people. And I've had situations where the firm found out that I was talking to them, and they on several dozen situations, particularly the great financial crisis,
Yeah.
where they almost got fired. So yes, I've had situations where it's difficult, but mostly what's interesting is people will tell you things that are kind of surprising to you. So I'll give you a public example because I
Sure.
wrote about it in my book. One of the great things about being on the floor is the bell ringings at the New York Stock Exchange. I always say to people, what would you give to meet all your heroes? Every rock star, every king and queen. I did 15,000 bell ringings at the New York Stock Exchange since 1997. That's a lot of bell ringings. And most of the time, they come in and ring the bell. And what's great is there's the CEO of Chevron right in front of you. And they know who I am. I'm the floor reporter for CNBC. They know Bob Pisani. And what's it like to spend 5 minutes with the CEO of Chevron? Well, if you're a reporter, that's kind of interesting. Now, you may not be doing any formal interview. You may just be sitting there, standing there. You're just chatting with him. But the PR people will move away for a few minutes, and you can say, "So, how's the oil business? What's going on?" I don't have a microphone in his face. There's no TV camera. It's just me and him chatting. But that could be very important, and has been, in terms of me commenting.
Sure.
Now, I may say, "Oh, I just talked to the CEO of Chevron," or I may just incorporate what he was saying into my general reporting without referencing him at all. One day, Barry Manilow comes. He rings the bell, and he's promoting an album he had out. This was 12 or 13 years ago. A colleague of mine, Bill Griffith, did a very brief on-air interview with him, and then he walked off. And I was standing there on the side, and he was alone. He was literally staring around like a tourist, looking at the floor of the New York Stock Exchange. It's very impressive, gold ceilings and all that. And I walked over to him. This was a complete shot in the dark. I was not a Barry Manilow fan. I'm a Led Zeppelin guy. I'm from the 1970s.
I was just playing.
Barry Manilow is not exactly my
Just yesterday,
cup of
we were
tea.
driving home from football practice. I was playing Kashmir and then Stairway to Heaven for my 14-year-old.
There's my life, Kashmir. So I go over to Mr. Manilow. Nice to meet you, Bob Pisani. I'm the floor reporter here. Nice to meet you, Bob. So tell me something. When you want somebody to tell you something, lead with something that's easy for them to talk about, and then get on to the question you really want to know. So I said, I understand you used to be a jingle writer. He said, "Oh, yeah, in the early 70s. Yeah, I love that job." I said, I understand you did the State Farm commercial. "Like a good neighbor, State Farm is there." He said, "Yep, I wrote that. I got $500 for it, and I never regretted it. It's famous." And I wrote other things. I wrote the Band-Aid commercial, Band-Aid stuck on. And he starts singing jingles that he wrote. I said, "This is kind of cool." Barry Manilow's like singing to me jingles because he was really interested in this. So immediately, Barry Manilow was there to talk about his album, but how do you get people you want to talk to animated? Find out what they really care about.
Yeah, absolutely.
He loved that period in his life. And then I said, here's something amazing. You're talking about this new album out, and you've got 18,000 people you're selling out here in New York. And you haven't had a major hit in years. How did you do this? What's the secret? And he said, "You know what? I'll tell you something. I had big hits in the 70s and into the 80s. And then all of a sudden, I didn't have as many big hits. But you see, Bob, I kept at what I was doing. I kept selling albums, and I had a very dedicated fan base for all of these years. They never really went away. I know you think that I went away because I didn't have all these huge chart-topping hits, but I stayed at what I wanted to do because I loved it. And I had the fan base to support that." So all of a sudden, he said, what happens if you stay at what you love long enough, suddenly people start writing about you like you're a legend. They started using that word, and all of a sudden, I'm back like other people. We were talking about Billy Joel, for example, went away, wasn't all of a sudden he's a legend.
Yeah.
And so here was him. I'm condensing a 15-minute conversation, but here's Barry Manilow, a guy I'd never thought of as a great intellectual, very honestly reflecting on the nature of fame, why he kept staying in it, and what it's like to be considered a legend. So essentially what he was saying is, I stayed what I wanted to do for years and years and years. And at the end of it, suddenly now I'm rewarded because I have a sort of a second career as a legend that's out there. And this paralleled my own career. I decided to stay at CNBC because I loved what I was doing there. There was nothing else I wanted to do. And so there was a little bit of lesson there. Who knew Barry Manilow was actually very thoughtful about a career path? And I use that in the book. And there are many anecdotes about people that I met who I didn't think we were going to say anything interesting to me. I didn't expect anything from Barry Manilow, but I thought and said, that's very thoughtful way to look at things.
One thing that I kind of wanted to go back to in time a little bit is it was such a big period of life for me and my profession. So, and I would say a lot of people who went through it was the global financial crisis, the GFC, Great Financial Crisis. I think people call it different, but that 2007, 2009 period, you were there, like metaphorically, literally on ground floor, right?
Yeah.
On the ground floor. Yeah. What was that like? Like, talk to me about the GFC. What did you see in the people you were interviewing? You know, what was going through, and then what was going through your own mind at the time?
Well, there were 3 great crises in my life in the 35 years at CNBC where I burned out 3 times. The first was in 1993, just working nonstop for 3 years, just sheer exhaustion, no vacation for 3 years. And I ended up checking into the cardiologist's office at the University of Pennsylvania with heart palpitations. And I was that overworked. And they basically looked at me and said, there's nothing wrong with you, but whatever the hell you're doing, you better stop because you're overworked and you're exhausted. The second crisis was the aftermath of the dot-com crash in 2000 and then 9/11. I was underneath the building when the second plane hit and saw the planes hit. And with the consequences, I was there on site that day and stayed for 2 months on site. I was the reporter on site for CNBC for 2 months. And the aftermath of that was very traumatic for me. It was a smoking ruin. A whole bunch of my friends were dead. We were in a recession, and I got out of that by learning how to meditate. And I literally joined a Buddhist meditation society that kind of emotionally got me out of it. And I was thinking of leaving CNBC. A lot of my friends were leaving the business too. But I ultimately survived that. The great financial crisis was the third time I burned out, and that was the worst one. Yeah, I know you might say like, oh my God, friends dying in the Trade Center. But the emotional impact of the financial crisis was even broader to me because essentially what happened was my generation, which is the baby boomer, I'm 70 now, almost 70. I'm the ultimate baby boomer, 1956. My generation flushed a good part of its savings down the toilet. I'm talking about stocks, bonds, and real estate particularly. And I'm assuming you don't want to get into the origin of the financial crisis, but this is when I really became a believer in behavioral economics because I saw what happened. So from the middle of 2007 to the bottom in March 2009, the S&P 500 dropped 50%. This was the biggest drop, essentially since 1930. 1929, 1930. And you would think that at the bottom like that, we didn't know March 2009 was the bottom. We didn't know that at the time, but it was. You would think down 50%. A rational person does not sell down 50%. Rational people buy down 50%.
If they have the money, yeah.
That is not what happened. I tracked, one of my jobs was tracking mutual fund flows. And in March 2009, again, that was the bottom, we didn't know it, flows increased, sales increased, people accelerated their selling. And I sat there and looked at this, and I actually have my blog posts because I had a blog at the time. I was in despair, essentially. Like, I can't believe that this is happening. And in behavioral economics, those of you who don't know what it is, behavioral economics purports to show how people actually act in a financial situation, not how they're supposed to act. So in theory, people are supposed to buy low and sell high. And what actually happens is they don't do that. They buy high and sell low. They act irrationally. And behavioral economics attempts to explain why does that actually happen. Without going into all these details, I remember sitting on the curb that day in March, and I wrote a story about it, just thinking, we're screwed. My generation this is going to take years and years to recover from this. And I didn't know that was the bottom either. Nobody knew what was going on. And so I remember just being filled with despair because I didn't know how we were going to get out of it. And what happened was, of course, there was massive amounts of money that was spent, which I completely supported. I thought Bernanke did a brilliant job. Bernanke was the head of the Federal Reserve, those of you who don't know, Ben Bernanke. And Bernanke was a student of the Great Depression. In fact, these guys all grew up studying what the hell happened in 1929, 1930. And the conclusion of the economists, of the economic consensus, was the stock market crash was not the reason for the depression of the 1930s. It was a precipitating event in what became known as the Great Depression. But the primary reason the recession was so deep was that the Federal Reserve failed to act to support the economy. Essentially, there was a banking crisis.
There was a run.
Liquidity was destroyed because there was a run on the banks.
Yeah.
And the Federal Reserve had technically the power to step in, but it was dominated by a group of people who were essentially laissez-faire economists who felt any government intervention was wrong, and they just let it play out. Well, that is a disastrous decision. And as a result of that, and excessive tariffs, global tariffs, hint, about today, that were the primary reasons why we had such a problem. So Bernanke and his whole generation grew up studying this. And when Bernanke finally was faced with his own crisis, decided we are not going to be laissez-faire economists. We are going to go all in and support the economy. And that's what turned things around. I mean, without heaven knows, I don't have any idea what would have happened.
In behavioral economics, why do people panic sell? Because again, logically, if it's gone down, that's not when you sell. That would be, when you go to buy, if you have the money to do it. And again, if you don't have any money to buy more, but certainly hold on. And then I'm going to ask that question in reverse, like, why do people buy? I don't want to say speculative, like Bitcoin's a great example. Like, obviously there's a lot of people who buy Bitcoin, and I say, hey, tell me about Bitcoin. Like, what is Bitcoin? And like, they can't explain it, but they buy it or they buy more of it. Why do people get so influenced based on what everyone else is doing?
Well, you're asking two things here, but
so that's how you know I'm a good reporter.
Let's just talk about why people act irrationally. Why do they not buy low and sell high? Why do they do the opposite? One of the things that came out of behavioral economics was a whole set of basic principles about why this actually happens. So there's a thing called loss aversion. And loss aversion basically says that the fear of a loss is far greater than the expectation of a gain. And that's basically the problem. So what happens here is people hold on to their losers way too long, basically. And they don't know how to act. And they stay with their winners for a long time as well. And so they don't know how to act quite rationally. So people, again, the fear of a loss, think about this, is far greater than the expectations of a gain. So if I am faced with the prospect of taking a loss on a stock, I don't want to do that. I'm afraid of taking that, because if I take that, now it's actually a real loss. In theory, this stuff is all in paper until you actually do anything, right? It's all just paper. But if I don't sell, then I haven't really exactly lost. Now, when I'm up, let me do this in a concrete way. If I'm up 10%, the pleasure I feel about that is not as great as if I was down 10%.
That's why I don't get
the loss. The feeling of that loss of 10% is far greater than the pleasure I get from the gain of the 10%.
Somebody asked me literally yesterday, "Hey, do you gamble?" I go, "Not really. I ostensibly never." And they're, "Why not?" I was like, because the feeling of winning is not comparable to the pain of losing.
Yes,
the joy of winning.
You just said it.
Yeah.
That's loss aversion. You want to get into Bitcoin, we can talk about that. This is about why people engage in speculative activity. In academia, this is called the penchant for engaging in lottery-like behavior. Why do people bet on the lottery? The lottery is a tax on poor people. That's what it is. And it is depressing to see it. It is depressing to see the numbers that the biggest players of the lottery are the poorest people. Rather than taking the money and putting it in the stock market or putting a down payment on a home, they play the lottery. Well, this is a metaphor for a lot of people's behavior in general. And I'm going off on a slight tangent here. One of the things that truly disturbs me is the spread of gambling culture in the United States. The expansion of sports gambling, which I think is evil, and the expansion of financial gambling. And they're aspects of the same thing. I don't know. Your family was quite famous in the sports business, and I don't know how you feel about it, but I think sports gambling is insidious and dangerous. I think it potentially corrupts the purity of the sport. I'm getting a little bit off a tangent here, but this relates to what's going on in the stock market and people who want to engage in lottery-like behavior. And there's a lot of very heavy speculative activity in the markets right now, and there are new developments that are enabling this speculative activity, options expansion in the options market, for example. You can essentially now bet on the stock market on a daily basis. You can engage in what I call zero-day to expiration options, where you can come in one morning and say, okay, it's 8 o'clock. I think the S&P is going to be up today. I'm going to put $1,000 on it. And at the end of the day, there are contracts that enable you to do this. For $1,000 in cash, you can bet on whether the S&P 500 is going to go up or down on that day, and where it closes depends on what you're going to get. If you don't, it doesn't go up, you lose your money. If it does, you get some little premium based upon how much it changes. That's basically gambling, essentially. And unfortunately, it's expanding, and I have a problem with it. I don't think it's sound investing principles.
What do you learn? What did you learn, or what have you learned, both as covering investing as senior financial correspondent, investor yourself, like where people how they can maintain discipline in investing and not chase the next big thing?
Yeah. So the important thing, I'm a Jack Bogle disciple. Jack Bogle was the founder of Vanguard and was a pioneer in index investing. Bogle's central insight, and this goes back more than 50 years, and this has been known, is that stock picking does not work. You think that you can pick stocks. You can't. There is no evidence that people can successfly pick stocks. So I say, do you have a diversified portfolio? Yeah, sure. I have 10 stocks. That's not a diversified portfolio. What they discovered a long time ago, and this goes back 60, 70 years, is that owning the stock market itself is the most successful way to make money. And the problem was, up until about 50 years ago, it wasn't possible to own the S&P 500. The S&P 500 is 80% of the stock market is in 500 stocks. You can now own that individually.
It's an index fund.
Through an index fund. And that's the most successful way. People think they can time the markets. People ask me all the time, so what do you think of the markets, Bob? What they really mean is, what do I think is going to happen in the stock market in the next 3 months, specifically what's going to happen with the S&P 500. And they want to try to figure out some way to time the market. And not only can you not pick stocks, you can't time the market successfully, because most of the time the market gains, the biggest gains of any year, are made on a handful of days a year.
Yeah.
But you don't know what days those are. If you're not in the market,
and if you do, you get in trouble if you trade on it.
Right. If you know, you don't know. So if you're not in the market on those days, it doesn't matter. It's not going to help you at all. But you can't predict that. So anybody that's logical will say, well, first off, I know that picking individual stocks is not going to outperform owning the stock market, owning the market. And I know that market timing isn't going to work. So I have to own the market, and I have to stay in the market. And then it becomes a question of risk tolerance. Okay. So how much can you afford to invest without losing any sleep? How old are you? Okay. If you're 35 years old, right now, the probability is you're going to live to 100. That's 65 years. And that's the central thing you need to look at, come into. How long am I going to be on this earth?
Yeah.
I'm 70 years old. I'm planning to live to 90. My actuarial friend says I should be at 95, whatever. The point is, I got another 20, 25 years of investing. If the market goes down, it went down 18% in 2022. People don't even remember that. And this is only 3 years later. Well, what does that tell you? That tells you that the market has a very long-term perspective, and people's their outlooks change. In this time, 3 years ago, everyone thought we were going into a recession and a potential depression, and it didn't happen. It never did happen. So anyone who would have sold, people were selling like crazy at that time. It would have been better to buy at that time. So again, it's a question of looking at your risk tolerance. How old are you? How much do you personally want to risk, and have a long-term perspective about that? Once you understand what your risk tolerance is, you say, okay, I have a 401k, I have $100,000 in it. I want to put 60% in the stock market and 30% in bonds and 10% in a money market, something like that. That's what you need to work on. And then you stick to it. And don't think that you can play around with it. Now, Bogle had answered. Everybody said, but that's boring, Bob. What am I supposed to do for 35, 65 years? I'm supposed to just put in the S&P 500 and go on vacation? Well, actually, yes. I did this with my wife in the mid-1990s, and we are, semi-retired, living off of that money that we started investing in the mid-1990s, 30 years ago. So yes, but Bogle had also an answer. Said, I know some people are not going to want to do that. So his answer was take 10% of what you got. So, you got $100,000, fine. Take $10,000 and go ahead. You be Mr. Stock Picker. You think Apple's going to outperform? You think NVIDIA?
Yeah, see how it works.
Go ahead, see how it works. Yeah. He said, but if you know how to accurately assess a P&L, a profit and loss, you're probably going to find you're not going to beat the market. But go ahead, knock yourself out and play it. So there's the way to play this game safely.
It's all financial related, but switching topics. So like social media has drastically changed how all information, especially financial information, flows. How people receive quote unquote financial advice. What are your thoughts on investors and just the investment field navigating social media effectively?
Yeah. I was one of the very first people at CNBC to use social media in 2009 or 10.
You had a MySpace account?
No, Twitter. When it started. No, I didn't have MySpace account.
This is a joke.
Thank you for bringing that up. I haven't heard that in a long time.
Exactly. I got you. But you started a Twitter account.
Very quickly, I discovered the good and bad news about it. The good news was it was a very interesting platform to get your ideas out. The bad news is
the comment section.
It's really a cesspool. To a large extent. It's actually gotten much worse.
Let me ask you, how many of those anonymous accounts you think are real people?
It's hard. It's literally hard to say.
Oh, yeah,
I can tell you this. Even now, and I've had periods where I pulled away from social media because I've been so unhappy with it. Even now, if I do something that's reasonably engaging, I can see a significant percentage that seem like bots to me. I don't have any way of knowing, but I get comments that are clearly slightly off from what they're saying. Yeah. That's designed to be promotional.
I think a good chunk are bots. I do this with I got 4 little kids and I try and teach them, somebody at school says something, it hurts their feelings. I try and teach them like, hey, like sticks and stones, break your bones, names will never hurt you. Don't let people's words, try not to give people power over your feelings. So sometimes we'll put something out and there you'll get some fiery comments. So I'll have my team print them out and I bring them home. We read them at the dinner table and we have a good time with them. It's like, they'll be calling me the worst names in the book. Obviously I'll bleep out the bad words, but just to teach them hey, people are always going to say things and you just got to laugh about it. But
one thing, and this is one of the maxims in my book, is that there's always someone who knows one fact more than you do on the most obscure subject imaginable, and they are very eager to let you know it.
Oh, yeah.
So I could be delving into the history of the S&P 500 or the history of IBM, and no matter what I say, somebody is going to message me, that was interesting, but you missed this, Bob, and trail off on this. That's kind of fun. What I have, a bigger problem I have is just the attitude. I call it aggrievement. Most people on social media, the branding strategy is aggrievement. They're angry. Mm-hmm. They're angry about something. Now, if you look carefully at what people say, most of the time, it's not about you. You think it is. So, I'll make a comment on the S&P 500, then I'll get some comments saying I'm an idiot. What really happens in most of these situations is most of the time it's not about you. Most of the time they're angry. Sometimes they're angry specifically at something that you said, but often it's not. They're angry at the stock market going down because they just lost a ton of money. They don't know why. They're just pissed off. They're angry at the administration because they think they're idiots. They're angry at CNBC because they think they're idiots, or they're angry at Fox. They think they're idiots, or they're angry at something, or they're angry at their job. They're not going anywhere, or they're getting divorced. Now, they don't tell you this, but what happens is these people are just angry. And so I always say aggrievement is a very poor branding strategy. Find something else to stand for. And this is the big problem that I kind of have with social media.
And as it relates to financial advice, are there certain accounts people should follow? How do you kind of judge between the legitimate accounts or financial advisor is the wrong term, but just kind of financial gurus on Twitter giving their thoughts and opinions versus the charlatans, the people who don't really know anything.
Well,
but
I will tell you something. There are. I know you think that there are famous people who I should always follow, and there are some. But I will tell you that there are famous people who've had long careers that I don't think very highly of. I don't think they're very intellectually rigorous or interesting. Some of these people just have
let's name them all right now.
Some of these people have just very good verbal skills, very good survival skills.
Good salespeople.
They know how not to piss people off. They know how to put out just enough content to sound relevant, and they're very good thinking on their feet. But I don't think they're very intellectually rigorous. Then I also know people who are very obscure who I think are brilliant, and I don't know why they never. Some of them don't have a lot of ambition. Some of them aren't very good sitting here in a conversation. You can read their stuff. It's brilliant. Try talking to them verbally. They're not so great. So you can see the limitations they have. So I'll tell you, I follow some people on Substack that are very interesting, that I think are good. I follow, some of them are fairly obscure. What's happened to a lot of my cohorts, I'm talking about strategists, analysts on Wall Street, is they left because the business is very difficult. Wall Street strategists, sell side, we call it. And they set up Substack columns. And one of the problems in the world today is there's too much of everything. There's too many podcasts.
Yeah.
I ran a podcast. There's too many blogs. I ran a blog. There's too many streaming services. There's too many newsletters. There's really too much of everything. And it's really, Mark Andreessen said, software will eat the world. And he was right. That was, I think, 15 years ago. And software has enabled us to eat the world, essentially. And it's good because it enables a plethora of opinions out there, but it also makes things very confusing and tough to follow.
One of the things I just was fascinated by, we were actually talking about as we walked into this room before we even started recording, was I made the assumption, you lived in New York, and you're like, no, I live in Philly. I'm from Philly. I live in Philly, and I've lived there, for however many 40 years. But what you did was you took the train up Monday morning, and you came back Thursday night?
Yeah, for 35 years, I left my wife in Philly at 5:30 in the morning and didn't see her till Friday night. I had an apartment in New York.
And I think the joke I made was, so that's the key to a successful 40-year marriage.
My wife likes to say, of course we had a successful marriage. We don't live together. That's part of the issues with the intensity of the job. My job as senior markets correspondent for CNBC was essentially a 60-hour-a-week job. I worked every Sunday for 30 years.
So that's what we've asked almost everyone in the chair you sit in, like, why, right? And you work so hard, you're away from family for 40 years, and then it was at 93 whenever you had you had to check yourself into the hospital, like you were overworked. What was it that was driving you and motivating you to sacrifice time with family, sacrifice your body, your health?
Yeah, it's hard to describe how exciting the job was. It was the perfect job for me. All of a sudden, and again, from 90 to 96, I was the real estate correspondent. In 1997, I became the stocks correspondent. And I became the stocks correspondent because from 1990 to 1995, we had very modest ratings. What put CNBC on the map was the internet. In August 1995, essentially, there were products to be able to buy that were internet related. Netscape was a browser that went public in August of 1995. It was the shiny object. The public was looking to find a pure play investment in the internet, and they didn't have it until they got that Netscape browser. So what happened was three things for us that made us famous. One was a shiny object, Netscape. Second was investing at home. People suddenly had computers that they could, like DLJ Direct, Schwab, where all of a sudden they could put on orders online and not go through their broker.
E-Trade.
Yes. This was revolutionary. Now, it took 20 minutes to get a confirmation. In some cases, the next day. It was terrible. It was really slow. By our standards, it's a joke. But you could do it. The third thing that happened was they had a forum where they could watch people discussing this, and that was CNBC. And we became famous on that. All of a sudden, we had ratings. So it really changed things, back then, getting involved in the internet business for us. And that kind of like helped make our whole business. And we rode that from 95 to 2000 all the way up.
And so really amongst the broad answer, it was the job itself. It just spoke to who you were, how you're wired, what you were interested in, what your skills and talents were going.
It was so intense and interesting. Look, if you would have asked me, what would I rather, is there anything rather, I wanted to be the science editor for the New York Times. I wanted to cover general relativity theory and the dinosaurs and everything. I'm a science guy. And that would have been my dream job. But when I saw this job, I said to myself, my God, this is like every skill set I ever was good at. I have to talk off the top of my head on the floor of the New York Stock Exchange and explain the stock market. And I'm not reading a teleprompter. Anchors read teleprompters, but reporters like me on the floor, you're basically talking off the top of your head.
Yeah.
That is really hard to do. And most of my hits weren't long, 3-5 minutes, something like that. 5 minutes would be long. But you have to know what you're talking about. You have to follow a sort of pattern a certain way because you're telling your producer you want to bring up charts, and you can't be wrong. If you're wrong, you'll hear about it. And if you do something simple, like you say 32 when you meant 23, you transpose words, letters, this happens. It will happen to you. You will hear about it. Someone out there will notice, hey, Bob, you said 32. It's 23, right?
You're like, oh.
Yes.
All right, I'm going to end with two advice questions. The first, what's the best piece of general advice on how to succeed just in business and life?
Well, I thought about this because I was talking to Allison about what generally would matter here. And I'd say 3 or 4 things. The first thing I would say about success in general is don't worry too much about what the rest of the world thinks about you. And I'll tell you the short answer. It's not much. It's amazing how little people think about other people. Most of the time, we are the center of our own universe here. So I used to say, at any moment, 10% of the viewers thought I was a genius, 10% thought I was a moron, and the other 80% were indifferent or undecided. And so what you need to do here is the joy lies in the process of creation, not in the reaction to it. Work for a goal for yourself. Get up, look at yourself in the mirror every day, and look at it in a very cold, hard light. And what you'll see is there's a guy standing here, and he's got certain dreams and aspirations, and figure out what your dreams and aspirations are. And I would say, you should be able to keep executing on that. Couple of quick things. Number one, in terms of my success, I've learned to live in the future a little bit. I've learned to live a little further out there. I have a chapter in the book called Bob 2.0 about how I keep reinventing myself, the skill sets that I had to keep learning, the new software, constantly reinventing myself, constantly figuring out what I'm going to be doing and what I'm going to be saying. When I became the stocks reporter, my job was to just cover the stock market. I decided I was going to become the IPO reporter, initial public offerings, because I was the guy on the floor and that's where they were. I declared myself to be the IPO reporter. Nobody said, you're going to be it. And they said, great. ETFs came in, exchange traded funds, ways to invest in indexes like the S&P 500. I declared myself to be the ETF reporter. I got a show. I got sponsors. The CNBC got sponsors around the show. It was a success. Nobody appointed me to. I decided to cover the SEC, the Security Exchange Commission. Nobody was doing that. And so I declared myself that was something that was important to me. So I would say reinvent yourself constantly and learn to live in the future. And finally, just very few things matter in the long run. And there are even less things that you can control. So there's like a Venn diagram that I always try, like focus on the intersection between the things that matter to you and the things that you can control. There's certain things in life that you can't control, including sometimes other people's opinions of you. But if you focus on the things that really matter to you, what you want to do and what you can control in that, then you're going to be successful. And that's what I tried to do.
One of the things you said, you were talking about declare yourself, is this concept of like you almost have to just start doing a job before it even exists or you earn it. There's a gentleman here, Matt Fitzgerald. His father had a great line. It was something like, you should never expect to be promoted into a job you aren't already doing. And that's something I try and teach young professionals here is like, don't wait for someone to ask you to do something outside your job description and or above your job description. Just start doing it. Just start making yourself useful, proactively saying, what can I do to help? And it's amazing how much your career will accelerate. You were saying like,
Yeah.
You just said, hey, I'm going to be the IPO expert and become an expert there. You didn't have to wait. It's that kind of go-getter mentality. You didn't have to wait for someone to say, okay, Bob, I want you to do this now. I want you to do that. You just did it. And then it just became this kind of broader part of your portfolio. Last question. We talked about advice, to succeed and just in general in life and business. Now, a little financial advice. If you had $1 to invest, where would you invest it?
I put it in the S&P 500 without a doubt. I mean, I'm one of the very few financial reporters I know that have published what I own. I did this in the book. I actually named what I own. And I did this for a reason. It's amazing to me. People ask me all the time, the central question people ask me if they stop me in the airport because they watch CNBC and know who I am. What do you think of the markets? That's the number one question. Sometimes it's like, oh, tell me about such and so personality on the air. Or what are they really like? That kind of thing. But most of the time it's like, what do you think of the markets? They never ask me the most obvious question, which is, gosh, you've been on the air for 35 years. They put your ugly face on TV. What do you own, Bob? What do you own? And that's like, isn't that the most obvious question?
Yeah.
Like, you're so damn smart, or you're so whatever the hell you are. They put you on TV.
Just kind of put your money where your mouth is. Like, what are you invested in?
So I was always shocked at this, and I find this is very common. People don't ever ask that, maybe because they feel it's too personal. But I decided to write a chapter on my investing history in the book and my mistakes and the stupid things I did 30 years ago, dumb things, like putting too much money in my own company stock. General Electric was our owner of NBC, and Jack Welch was the
He was
CEO.
on fire.
He was a god. I knew Jack Welch, and he loved
I read
NBC.
his book. But was it scraping the bottom 10%? Gosh, what do they call it? Yeah, he had a whole philosophy in the professional world.
Yes, fire the bottom 10%.
Yeah, fire the bottom 10%. But the whole world loved everything he said until it didn't work anymore.
Yes, and I made the classic mistake of believing that this is a behavioral bias. This is behavioral economics. The bias was not bias in my own excessive self-confidence. It was a bias in him. I had excessive self-confidence in him. I thought Jack Welch could do no wrong. I want to own what Jack Welch owns. Well, Jack owns GE. And in 1999, this is in my book, in the summer of 1999, 50% of my 401k was GE. Now, anybody who was an investment professional would say, oh boy, that is really stupid, Bob. You do not do that. Now, there's not a rule, but certainly 10%, that's like maximum. I wouldn't even go close to that.
Sure.
And so here's the problem. I knew this was stupid. I was the stocks correspondent. I knew that you don't put 50%. It's too risky putting 50% of your money in one investment. Anyone will tell you that's too risky. I knew it. I did it anyhow. Why? This is what I mean with behavioral economics. There are biases in your head that literally infect your thinking, that make you stupid. In this particular case, I believe Jack Welch was God. He could do no wrong. I thought this is the way to go. And intellectually, I knew it was idiotic. Emotionally, I just didn't pay any attention. So this emotional part of me overrode the intellectual part that knew I was acting stupidly. So the bottom line is it blew up in 2000. And not only did Jack leave, but the market went down and they refused to give General Electric the multiple for a conglomerate. It was a conglomerate that they thought it deserved. And it suffered for years and years and years. Well, there I am. It set my investing life back ages. I don't know how many years. All I realized was when I finally kind of woke up, and it took me several years to sell the thing. That's how dumb I was. Twice I was stupid. Too much invested in it and too slow to move. By the time I figured that out, I had to take enormous risks. I had to put all my money in the stock market, just really your game, and then got blown up again in the financial crisis. So the bottom line was you learn very hard. And I published what I own after I met Jack Welch in 1997. I got a little smarter, made that stupid mistake with G, but got smarter. And I basically own index funds. S&P 500 is my core holding. In case anybody's wondering about 72% of my 401k is stocks, mostly index funds. So I own a S&P 500. I own a mid cap. I own a small cap value fund. I own an international fund. It's market cap weighted. I own a broad bond portfolio, broad bond fund, and I own a money market fund, which is throwing off 4%. So it's about 72, 20% bonds, 5-6% money market. And when I show this to them, and you can put it on an index card, people are invariably disappointed. I mean, they really are disappointed.
They thought you'd have
they
some
look like right. They look at you and say, "This is it, Bob. You
sprinkling a little NVIDIA."
Right. You own the S&P 500 is your core portfolio. I said, why would it not be your core portfolio? Yeah. And they say, no, but Bob, tell us what you really own. Like, what's the secret stuff? Like, show us the
American economy,
leverage and inverse, Malaysian bonds. They think there's some secret thing that exists, and I say, no, there isn't any, and they're just so disappointed. So you explain that to them about why they shouldn't be disappointed.
Slow and steady wins the race. What is the GE for everybody today? What is the biggest kind of red flag for you in today's market where you think people are just too concentrated or too
much risky behavior in general? Look, you were mentioning Bitcoin. This is a rabbit hole. I don't know if we want to go down. I think there are some legitimate use cases for Bitcoin. This argument that Bitcoin is essentially a play on fiat currencies and governments around the world print money because they're not tied to the gold standard and therefore the money is worthless. There are some countries where that is true. It is not true in the United States. I would rather put my full faith and credit in the U.S. government than in Bitcoin. I'm sorry. But I understand there are some use cases. Is Bitcoin money? No. Not in the traditional sense, but is it some kind of asset class? Yes, it is. So here's the question on something like Bitcoin. What does it do for your portfolio? You're a professional manager here. You own stocks, bonds, you own real estate. You have a portfolio. You look at it and say, okay, I want to add something new. I want to add gold. Mm-hmm. I want to add a coin collection, collectibles. I want to add Bitcoin. The first thing you would do as a portfolio manager is say, well, what is this doing for me? Would it improve my returns? A lot of people, frankly, that's what they're interested in. And not just that, it's a get-rich-quick game here. The interest in Bitcoin is entirely speculative. Okay, so it's not like, oh, we're doing a play on fiat currencies. Most people can't even spell fiat currency. Give me a break, seriously. So, okay, do you think it's going to improve your return? Does it reduce the volatility of your portfolio? Does it tampen it down or does it increase it? I don't know. It probably increases the volatility of it. What is it doing for you other than, I just want to get rich quick? I don't know what the hell it's doing for me. See, that's not a reason to suddenly go out and start buying. I think the biggest driver for Bitcoin, I just speaking from my experience in the people I know that are closest to me, they're heavy investors, I swear it's just a FOMO. It's just, it's gone up, right? And they know people who've, at least on paper, have made a lot of money and they don't want to miss out. Right. So here's the way, FOMO means fear of missing out. Yeah. Here's how you can look at this. Wall Street tries to make it safe for you to do this. So before COVID, the game was, okay, Bob, this is what you do. Take 1% of your money and put it in Bitcoin. Because you see, if you lose, the whole thing crashes and goes to zero, okay? Well, then you've only lost 1%. But suppose it doubles. Now you have 2%. This is what I call the pretzel logic of Wall Street. You got to do it. But see, you're in the game now, Bob. You're in. Then notice it changed. Most of those people are now saying, oh, it should be 5 to 10% of your money. And I have friends who are arguing 40% of your portfolio should be in Bitcoin. So you see how they sort of slowly drag you in. And part of this is the attempt to legitimize the asset class. That's what the game is. If we can get more people, if I can get Jamie Dimon to stop saying so many negative things about Bitcoin, it'll be more acceptable eventually. And there is increasing institutionalization of Bitcoin going on. They have succeeded in making it somewhat more
mainstream,
and mainstream.
Well, you've had an incredible career in television, but you might have missed your calling as a trader because the way you sold that, I was like, okay, I'm gonna go out and I'm gonna buy some Bitcoin. I just got to get in the game, right?
Yeah, you got to be part of it.
No.
So I think the important thing here is, I want to be in favor of financial innovation. By the way, I'm a big backer of blockchain. I think blockchain has tremendous possibility for transferring real estate, for transferring money, for settlement of stocks and bonds. Bitcoin is one particular small usage for blockchain. It has an advantage of being a completely decentralized kind of currency. But that's only one little tiny example of what you can do on blockchain. I believe in blockchain, and I'm a big believer in financial innovation. I mean, electronic banking. I think it's the biggest thing since electronic banking 50 years ago. I'm a big. I don't want to make it sound like I'm a curmudgeon on this. I have some particular intellectual problems with Bitcoin and with cryptocurrencies that I don't particularly have with other things that are associated with blockchain. So the last thing I want to leave you is support financial innovation. We need to keep doing that to grow as a country.
Well, I mean, you have a much more educated opinion on all of this than I do, and I know a lot of people value that opinion. One of the best ways to get it, is you had mentioned your book, Shut Up and Keep Talking, Lessons on Life and Investing from the Floor of the New York Stock Exchange, available wherever books are sold. Bob, this has been really fun. I just, for everyone listening, make sure to follow Bob Pisani on LinkedIn, Substack, and bobpisani.com, and also on X at Bob Pisani, right?
Yes.
And if you found value in this episode, don't forget to follow me on X, Instagram, TikTok, and LinkedIn. Just search Kyle Matthews, CEO, and catch more inspiring conversations on the Matthews Mentality Podcast, wherever you listen. Bob, this is fun. I'm going to go out and get me some more Bitcoin. I'm going to buy some S&P index funds.
I'm going to load up
on some fiat currency. But no, this is great hanging, and I can't thank you enough for coming.
Enjoyed it very much. Thank you.